Hey there, in this video we're going to be discussing some of the key financial terms related to borrowing and credit. So if you're someone that's looking to apply for a loan or a credit card, or you simply want a refresher, we've got you covered in this short video which will explain some of the jargon to help you make more informed decisions. First off, let's talk about interest rate. This is just the cost of borrowing money. So if you owe money, you'll be expected to pay that back, but also pay some interest on top. So essentially think of it as a price you pay for using someone else's money. Closely related is APR, or annual percentage rate, and this is simply the yearly rate of interest that you may have to pay. And it's really useful to use APR when comparing different options out there, as it not only includes the interest you pay, but also any other fees or charges that are included. Next up, we have credit report, and this is really important because it shows your history of managing and repaying debts, and it's held by credit reference agencies. And it's really important because it can actually impact the rate you pay or your ability to borrow credit in the future. So a credit reference agency is an independent organisation that holds your credit report. In the UK, there are 3 credit reference agencies that you should know about. These are Experian, Equifax and TransUnion. And they play a big role in determining your credit worthiness. Next up, we have credit limit. This is the max amount you can borrow on a line of credit, such as a credit card. It's really important to consider this because you can avoid penalties and look after your credit score by doing so. There's also the term minimum repayment. This refers to the minimum amount that you'll be expected to pay a creditor each month to avoid charges. With a credit card, this will be a proportion of your total balance. It's really important to remember that whilst it's tempting to pay the minimum, by doing so, you could end up paying more interest in the long term. Now let's differentiate between a secured loan and an unsecured loan. A secured loan is when you borrow money and it's backed by an asset you own, usually your property. Whilst these loans will usually come with a lower interest rate, they can carry the risk of losing your asset or losing your property if you can't keep up with repayments. On the other hand, unsecured loans are a bit more straightforward. This is where you borrow money off a lender and agree to make regular monthly repayments until the loan is paid off. Whilst they're more straightforward, the interest can be higher, and they are more risky for lenders because there's no collateral behind them. And let's not forget about the term default. A default can occur when someone fails to meet the required payments on their debt. It's really important to meet your required payments to avoid default charges or late repayment charges. Finally, let's clarify the term balance. This is the total amount you owe to a lender. It could be a credit card company or a loan provider. With a credit card, if you make a purchase, your balance will increase. If you make a repayment, your balance will go down. Whilst with a loan, your balance is the total amount you still have to repay. And that's a wrap. In this video, we've discussed 10 key financial terms. Hopefully, you've got a better understanding of them and you'll be able to make more informed decisions when it comes to lending. Hope you enjoyed, and thanks a lot for listening.